Good evening and welcome to our market coverage. Let's dive straight into the numbers. The Nasdaq closed at 26,270, up 1.54%. The S&P 500 finished at 7,432, a gain of 1.08%. The Dow Jones Industrial Average reclaimed the 50,000 mark, settling at 50,009, up 1.31%. The VIX, our fear gauge, edged lower to 17.83. The 10-year Treasury yield dropped to 4.57%. The dollar index held at 99.39, while the offshore yuan strengthened to 6.80 against the dollar. Bitcoin ticked up to $77,504. WTI crude oil, however, saw a sharp sell-off, plunging nearly 6% to $98 a barrel. Spot gold was relatively flat at $4,481 an ounce. Now, let's talk about what this all means. The market's character today can best be described as a bullish trap reversal. Money flowed out of short-term safe havens and selectively rushed into the most beaten-down sectors that are sensitive to interest rates and oil prices, like semiconductors and travel stocks. But this was not a broad-based bull market rally. It was a targeted, sentiment-driven move. Looking at the global picture, the absolute pivot point today was the U.S. equity market. Asian and European markets opened cautiously, consolidating on low volume with no clear direction. But when Wall Street opened, risk appetite was ignited instantly by the double tailwind of falling bond yields and crashing oil prices. The three major indices gapped up and rallied hard, completely breaking away from the cautious tone seen in other regions. So, what exactly is the market pricing in? Interestingly, the market completely ignored a slightly stronger dollar index, which would normally pressure stocks. It also ignored a sharp decline in the materials sector, which is often seen as a bellwether for economic growth. This selective blindness to bad news is a hallmark of an emotional, sentiment-driven rally. It feels strong, but the foundation is shaky. Our own forecast for a consolidative session was proven wrong. We severely underestimated the market's hunger for any tangible good news after a prolonged sell-off. The key takeaway today is that the market's priority shifted instantly. The disinflation and valuation relief brought by lower oil and bond yields completely overwhelmed the previous fear of Fed tightening. This leads us to an important new structural signal. Today was not a broad-based rally. There was significant internal divergence. On one hand, semiconductor stocks, which are highly sensitive to interest rates, and travel stocks, which benefit from lower fuel costs, exploded higher. On the other hand, the materials sector, which is sensitive to global growth, was the biggest laggard. This tells us the market is not betting on a broad economic recovery. Instead, it is executing a structural trade based on falling inflation. Capital is betting on a dual narrative, a recessionary cool-down that benefits tech valuations, and a cost-driven recovery that benefits travel. This is a complex and potentially unstable new structure. What should we watch for tomorrow? Asian markets are expected to open significantly higher to catch up with the U.S. rally. Technology, new energy, and some consumer sectors will likely lead the charge. However, we must be cautious. The strength of the dollar is a potential headwind that could limit the flow of global liquidity. Also, keep a close eye on any Fed speakers tomorrow. A hawkish comment could quickly extinguish the optimism sparked by lower oil prices. The key level for WTI crude is $95. A break below that could reignite recession fears, while a quick bounce back above $100 would rekindle inflation worries. To sum up, today's rally was a violent, sentiment-driven correction. Its sustainability needs to be confirmed over the next 1 to 2 trading sessions. Our strategy is to lean cautiously bullish with controlled positions. The conditions for this to work are that Asian markets hold their opening gains and the 10-year yield does not spike back above 4.62%. However, this strategy is immediately invalidated if the VIX jumps back above 20, or if oil prices break back above $102. In that case, we would immediately shift back to a defensive posture. For now, our probability assessment is 45% for further upside, 40% for consolidation, and only 15% for a decline.